Hi, welcome to our session on the pension plan transfer process. Glad that you could make it. I'm Nicole Kervorst, and I'm here from Arthur J. Gallagher. We're helping out with the process of transferring the plan over to an insurance company. In my role, I'm an actuary, so if anyone has specific questions about how the annuities were calculated and converted between the different options and how your lump sum is calculated, those are good questions for me to answer. And I'm joined here by two other colleagues who can help answer different kinds of questions. Kendall?
So it's Kendall Storch. I also work at Arthur J. Gallagher. I work primarily with the 401k plan. Perhaps you've sat in on some of the WebExes I do a couple times per year. So I'm here to talk about a few of the slides as part of our presentation. And then finally, we also have Felicia.
Hi, I'm Felicia Kervorst. I help run the call center that we have to support all of you, to answer your questions and to help you make your decision. So what we have here is a brief overview of the pension plan transfer process. You can type in questions as we go through, and we'll try to answer as many questions as possible. So what is happening, as we said before, the pension plan is transferring all responsibilities and costs and maintenance over to an insurance company. And what this means is that the pension plan is currently or will be very soon 100% funded. And what this means for participants in the plan, especially for actives, there'll be a few options that aren't normally provided in the plan. For employees who are no longer with DSO, you'll be given the option to take a lump sum payment of your benefits. And we'll go over each option a little bit later on in the presentation. Why is DSO doing this? Well, for DSO, as I said before, all responsibility of administering and maintaining and paying for the pension plan is going to shift over to the insurance company completely. It's actually cheaper to buy annuities for all participants than it is to continue to administer the plan themselves. So it's a very good thing for DSO. And then for participants, you do get more options that you wouldn't normally get. And so you get the opportunity to control your retirement benefits. So for anybody who is listening, who is already receiving a benefit from the plan, your payments, your monthly payments will continue on with no interruption. And if you're currently receiving a paper check, the only thing that will be different will be that the check will look a little bit different. It'll be coming from a different check writer, but otherwise nothing will be changing.
Okay, so in terms of what happens if you haven't already started taking benefits, I think what you'll find, especially if you receive one of the packages, is there's a variety of different kind of choices that people are going to need to make with respect to their pension benefit. So those choices really kind of fall into, I'll call it one of three different categories. So category number one is you can elect to take a lump sum. So again, in the packets, there is a calculated value of essentially what the stream of your annuity payments or your pension payments would look like if you got it paid you all at once. That's basically what the lump sum is. So if you elect to take the lump sum, again, you have some choices. You can take the value of the lump sum and roll it into the DSO 401k plan. If you did that, there's no taxes or penalties. You could elect to take the lump sum and roll it into an IRA account. Again, there's no taxes or penalties. You could say, hey, I'll take that lump sum and I'm going to just take the cash. I'm not rolling it into another tax sheltered vehicle. I'm just going to stick all of the money into a suitcase, and I'm going to fly out to Las Vegas and have a grand old time. You could certainly do that as well. Obviously, if you take the cash, then you will pay income taxes on whatever you receive, and if you're under age 59 and a half, you'd be subject to a 10% excise tax penalty. So even within the lump sums, there are choices in terms of kind of what you want to do with the money once you get it. So that is one option. The second option is you could elect to start taking annuity payments right now. So you'd begin to start receiving a check. Again, within the packets, there are a variety of choices around different ways that you can select the annuity payments. You could have the annuity payments be over a single life expectancy. The annuity payments could be over a joint life expectancy. There could be different amounts that the surviving beneficiary would receive. You could have a certain period of time that the payments are guaranteed to be made. So that would be a period certain annuity. So again, within the packets, there are a variety of different options in terms of different ways that you can receive those annuity payments. But again, those are for people who are looking to start the annuity payments now. The third option is you can say, I'm going to take an annuity, but I don't want it today. I'm going to take that annuity at some point in the future. So that would clearly not trigger any tax or penalty because you're not taking any money. You're just saying, I want to defer the receipt of the money until some point in the future. My one sort of comment on this, just to make sure that it's 100% clear for people, is the lump sum option is a one-time option. So if you don't elect a lump sum as part of this election period, which is through February 18th, the lump sum option comes off the table. So if you are interested in lump sum, now is the time to do it. You can't say, I'm going to defer my annuity or I'm going to take annuity payments and then 3 weeks later say, oh, wait a minute, I want to take the lump sum. That's not an option. Okay. So if I defer taking the annuity, what happens then? So the annuity will, the value of the annuity will still exist. So it's sort of set aside and waiting for you for whenever you're ready to claim it. The dollars that are in the pension plan are going to be transferred to an insurance company. So it will be the insurance company that will pay out the annuity benefit to you when the time comes, when you're ready to start taking those benefits.
All right, so from an actuarial standpoint, I get a lot of questions about how the lump sum is calculated. The lump sum is based on three basic factors. The first is your accrued benefit. So as of age 65, the plan defined your accrued benefit. And it was based on how much money you earned through the date that the plan was frozen and how much service you earned until the plan was frozen. That's defined at 65. The second thing that the lump sum is based on is how old you are now and what the expectations for your lifetime are. Those expectations are set by the government. So every so often, a group of actuaries gets together at the Society of Actuaries and they study what's happening with expected lifetimes. And they separate that into different cohorts of people so that it includes, you know, healthy professionals and healthy annuitants to try to understand how long people are living. And people have been living longer and longer. You know, we're seeing that these mortality tables are extending lifetimes quite a bit. The latest table also includes a generational kind of table. What that means is that they've understood that because of medical advancements and changes, people are living longer, and what they're doing is including future mortality improvements and reflecting those into the table today. So instead of just saying, oh, we're just going to use whatever expectations we think are happening right now, we're going to assume that in the future this trend is going to continue, and people are going to be living longer and improving on mortality. The third thing that the lump sum calculation is based on is interest rates. And those interest rates are mandated by the government. What the government requires is that you assume that participants in these plans are going to take their lump sum money and they're going to invest it in high quality corporate bonds. That means that there's an assumed interest rate return of around somewhere between maybe 4 to 5% return on these lump sums. What that means for you, if you select a lump sum and you're able to achieve a higher return than what was assumed in your calculation, then you're going to win, basically. So if you, instead of just investing in fixed income bonds, instead if you maybe mix in equities into your portfolio, and if trends on what returns have been continues, you might be able to earn 6.5% instead of the rate that was assumed in the lump sum calculation. One of the things that I wanted to mention, I've had a number of people ask questions about the calculation, and they've said, if I take my lump sum and I divide by my age 65 annuity payment, and I multiply by 12 or whatever, you're assuming that I'm only going to live X years, 8 years or something like that. You, instead of looking at the calculation in that way to figure out like how many years is this lump sum going to last, a better way to do it is to take the lump sum amount, increase it with interest on an annual basis all the way until 65, and then start deducting each year a set of annuity payments equal to your age 65 accrued benefit, and in between each year, roll it forward with interest. And if you do that in a spreadsheet, what you'll see is the money is going to last a lot longer when you include that assumption of interest accumulation into the calculation. The other question that I get a lot is, what happens to this money if I pass away? So it depends on what you do with the money. So if you take a lump sum right now, then you'll get the full value of your benefit. If you put that money into an IRA or into a 401k or into a bank account, and you leave it and let it grow with interest, it'll be there in case you pass away to your spouse or to your heirs. If you take an annuity right now, then what benefit is available to your beneficiaries depends on the election option that you choose. So there's a few different options that provide for spousal benefit coverage, and then there's one that provides some period of time, that 10-year certain in life provides a guaranteed benefit for 10 years that you could give to a child or some other heir, just in the annuity amount that you're receiving. So if you pick a $100 benefit and you happen to pass away, 5 years through, then for the remainder of the 5 years, someone will continue to get that $100 a month. If you decide to defer your annuity until later, so if you say, oh, I'm 50 years old right now, I don't want to start my annuity until I'm 65, and let's say you die prior to age 65, if you are married, your spouse will receive roughly half of that annuity benefit. And I say roughly because there's a slight age adjustment. If you and your spouse were the same age, it would be exactly half. If they were younger than you or older than you, there'd be a just minor adjustment for that age difference. So we talked a little bit, Kendall mentioned a little bit about taxes. So no matter when you take this money and start using it for spending purposes, you're going to have to pay tax on it at some point. There's no way to completely avoid taxation. If you decide to take monthly annuity payments right now, that money will get taxed just like regular income. If you roll it over to either a traditional regular IRA or to a 401k, then you don't pay any taxes now. You'll wait, and later on when you start withdrawing money from those accounts, then you'll start paying tax. If you decide to take a lump sum right now, we're going to withhold from your check a little bit of money for both the federal government and potentially the state that you live in, depending on state rules. Every state is a little bit different. Federal, there'll be a 20% withholding, and that's just an estimate as to how much your taxes are. When you then file your taxes in the early part of 2020, it'll get trued up. So depending on your tax bracket, you may either owe a little bit more money or you may get some of that money back. If you are under 59 and a half, then there is a 10% penalty for taking out money early. So you want to keep that in mind. That 10% does not get deducted from your check. That's something that would then get paid when you do your taxes in 2020. Okay.
A couple of important dates to point out, as well as some things about these dates. We've got the window closing on February 18th, which we have identified is a holiday.
President's Day.
It is President's Day. So if you could get your election forms into the blue envelopes sent with your packets and in the mail by the 16th, it's only a mailing date. And that the same goes for lump sum checks. They will not, don't expect to receive them on April 1st. April 1st is the date that the check writer will be sending them out to you. So we generally suggest waiting about 2 weeks for the checks to go through the mail. And if you don't receive them for whatever reason, please give the Pension Service Center a call, and we'll get you a new check sent to the correct address or whatever the problem may have been. The insurance transfer will be going through from April to June, and when the insurance company is chosen, we'll be sending out letters to everybody who has decided to defer payments or who is already receiving payments right now. And that will tell you who the insurance provider is going to be, and it will contain a phone number for you to call when you do want to start payments. This is the election form that you received in your packet. And if you want to choose the rollover option or the lump sum option, you'll have to fill this form out. It's pretty simple. We'll need your signature, last four of your SSN, and a daytime phone number in case we have any questions about your form. Most of those problems can get resolved over our recorded call center line, so that's a nice feature of the call center. And then you will check one of the option boxes, and one option that is kind of special that we like to point out here is the split distribution option. If you would like to take some money as cash and pay off some high interest credit card debt, or you just would like some money in your pocket and you want to roll the rest of it over, indicate how much you would like to take in cash, and then check the option for what kind of rollover you'd like the rest of the money to go into, and we'll do the subtraction there. You don't have to worry about doing the math. If you would like to select the Dassault Systems 401k rollover option, all you need to do is check the box. We'll make sure that it gets there. what's going to happen is there'll be one wire transfer of all of the money into the account, so you don't need to indicate a financial institution on the line. If you are married, no matter if you would like to select the cash option or the rollover option, your spouse will need to sign the back of the waiver in front of a notary. And I think we identified that there was not a notary public in either the Woodland Hills or North Carolina offices, but you can find a notary public in any UPS store. Most banks or grocery stores have them.
Sometimes libraries.
Sometimes libraries as well.
Yeah.
As we were talking about on the form, one of the options is that you can roll the lump sum payout to the Dassault 401k plan. Typically, when you do a rollover, there is a variety of paperwork that you have to fill out, and generally you might receive a check, and then you have to mail that check back with a rollover form of some sort. So we've eliminated some of those other steps that normally take place with rollovers. So in this instance, with the pension plan payout, basically all you have to do if you want to roll your money into the Dassault 401k is check the box on the election form. As Felicia was saying before, we're going to get one lump sum wire from the pension plan, and then we'll get a breakdown of how much money belongs to each person. So Jane gets $100, Bob gets $50, etc. And then all of that money will be wired to Fidelity. Fidelity will then take the money and the allocation and then deposit everybody's respective piece into their 401k account. When the money goes into your 401k account, it's going to be invested based on the investment elections that you have coded on your account currently. So if you're putting your every 2-week payroll deduction 401k contribution into 4 different funds, and then the wire comes through from the pension plan, that money is going to be invested into those 4 other funds as well. So it's just going to follow your current investment elections on your 401k account. I will say some of the questions we've gotten before is, well, what if I want my money to go someplace else within the 401k? Couple of choices. You can either have the dollars flow into the existing investment options that you have presently, and then once the money is there, you can go into your net benefits account and rebalance your portfolio. That would be one way you could do it. Alternatively, before the wire comes through, and again, we're anticipating that the wire will come sort of early in April. If you said, okay, at the end of March, I'm going to go into net benefits and rejigger where I want future contributions to go, you could certainly do that. And then when the wire comes across, it will look to see, okay, what funds are coded as to where the dollars should go, and the money will go in that way. So either you can kind of do it on the front end by adjusting your investment allocations prior to April 1st, and then you just have to put it back once the wire comes through, or you just let it go into whatever funds you have currently and you rejigger your account once the dollars are there.
Kendall, one other item, just in regards to that, some people were talking about that specific option of how or when to rejigger your 401k account. And another option is, the dollar amount that would be coming in.
Right.
In essence, you could move that money to cash or whatever from your existing account, so that you're not playing with your future funds or the money that's coming in. You could, in essence, just withdraw those funds from their current investments and put it into cash or whatever option you wanted to, so that you're not trying to time when the money's coming in and what it would fall into. You could, in essence, sort of preempt that by doing that with the money that's already in your 401k plan today.
Yeah, maybe I'll just do, just so everybody's following that. So let's say you had $100,000 in your account and you're getting a $50,000 lump sum payment. You could take $50,000 from the $100,000 that's sitting in your account today and move that into cash. And then when the wire comes through, that will basically replace the $50,000 that you moved out of the market, for example. So that would be another way that you could handle it. So really 3 kind of different ways that you can kind of control where you want the pension dollars to go.
And we also talked too about the idea of if you are rolling it over potentially to an IRA, you're going to receive a check. And so alternatively, you may want to consider rolling it into the DS 401k plan. With your 401k plan, rollover funds can be withdrawn or rolled over to another account like an IRA at any point. So you're not tied to that 60-day window of you receiving that check. You need to take some sort of action, putting it into your 401k plan, and then taking some action whenever you're ready, whenever you've got your IRA account set up or that you're ready to take the time to do that transition, just as another alternative.
And we might have some people on the line that are former employees that maybe move their money out of the DSO 401k. And so if that's the case, then you would not need to select a different option. So the DSO 401k wouldn't be an option anymore, but you could pick your current employer's 401k plan and roll it into there as long as they allow that. Most plans do. Or you could, set up an IRA. And you don't have to have the IRA account set up ahead of time. You don't have to open it. You just have to know that it's available. So Fidelity, for example, has an IRA product, and you don't have to have that account established ahead of time.
Just one other quick comment on the lump sum election form. So I'm going to slide back to here. So we were talking about the name of the financial institution. So you don't have to fill in that line if you're planning on rolling the money into the DSO 401k plan. If you're planning on rolling the money to your Charles Schwab IRA account, then you would want to fill in the name of the financial institution line.
Right. So you put Charles Schwab then on that line.
Yep. Exactly.
So I think we've been seeing some questions coming in. So Colin, do you want to maybe repeat, tell us what the question is, and then one of us can answer?
Absolutely. So I will start off by the number one question that we get every time is, are we recording this session, and can we get a copy of the slide deck? And yes, these will, both the recording and the slide deck will be sent out to our employees. If you are a vested term and are on the call and you would like a copy, send me an email, so I've got your email address so I can send that to you as well. But in terms of first questions, we'll start with this one, and I think it's probably just, again, thinking through the transition that we're having here of terminating the pension plan. It's sort of a question about this annuity payment and the ability to, so what we're saying is you can start an annuity payment now, even though you're still working at DSO systems, correct?
Yeah.
That's correct.
Okay. And can I roll over my lump sum to an IRA account, a self-directed IRA account?
Absolutely. Yeah.
If we receive, If I cash out the full amount, and again, this is as cash, apart from the fact that I'm paying taxes, what is the penalty again?
Yeah, so there's a 10% penalty. So if your lump sum that you're taking in cash is $50,000, then there's a additional, on top of taxes, there's a $5,000 penalty that's paid to the U.S. government for taking that money out early. And that's the same, if you took money out of a 401k early, that would be the same kind of penalty.
How do we define early?
So early is generally before 59 and a half. There's a list of exemptions. They're pretty rare. Like if you're disabled, there might be an exemption. If it's the result of a quadro and you're the alternate payee of a quadro, then there's no penalty. The most common exemption is if you left DSO after the age of 55 and you haven't hit 59 and a half yet, then there's no penalty for you. So,
is it possible to, in essence, direct, let's say I have a loan for my 401k, is there any way to direct the lump sum to go towards my 401k loan, or do I have to, in essence, take that as cash and penalty?
Yep. So there isn't a mechanism to say, okay, I want part of the money to go into my 401k account and part of the money to repay an outstanding loan. I think what you would end up doing is you would choose the split option on the lump sum form to say, I want to roll over X amount, and I want to take enough money to pay off the loan in cash. So you would essentially get two checks. One would go to the 401k plan, the rest would go to you. You would take the cash and use that cash to pay off the loan in the 401k. So granted, if you take cash, that triggers tax. So the tax is going to happen. And again, if you're under 59.5, you'd have to watch out for the 10% penalty, but it would provide you the cash you need to be able to pay off the loan all at once. So that would be, I think that would be sort of the mechanism that you would use if you wanted to pay off the loan all in one fell swoop. Alternatively, again, you roll the whole thing into the 401k, or you roll it someplace else and you just keep making the loan payments until they're done.
And similarly, if I do choose to roll over my funds to the DS 401k plan, is that in any way impacting the typical annual limit, so $19,000 or $25,000 for 2019? Does this money coming into the plan have any impact on that?
No, it doesn't. So the money that's coming over is treated as rollover dollars. So it's not new contributions, so to speak. So any of the rollover money doesn't have any impact on your annual limits.
Okay. Can you think of any advantages or disadvantages of transferring or rolling over your lump sum to the 401k versus an IRA? And this person had added in that they've heard that 401k to a Roth conversion has fewer restrictions and costs than an IRA to a Roth IRA conversion.
So usually, from a tax standpoint, there really isn't a difference. The tax treatment, whether you're rolling to a 401k or an IRA, is the same. Typically, people are rolling to the IRA for investment flexibility. So if you want to roll to the IRA, chances are you're interested in buying individual stocks, buying individual bonds, buying ETFs, buying options. All those are things that you can do within the IRA account. You can't do those things within the 401k plan. So investment flexibility is probably the primary driver there. If you are thinking about converting any of this money to Roth dollars, the IRA is probably the better choice. It's a little easier, I would say, to do Roth conversions from a traditional IRA than trying to do it in the 401k plan.
Okay. And if I'm choosing an annuity, so I'm deferring, so I am not taking this money now, but I'm going to wait until retirement. What do I need to do, if anything, now?
So what you would do if you want to defer is just call the call center, and we will record on your record that you're choosing to defer.
Okay. And with that, you're not doing anything in terms of selecting the type of annuity or anything at this point. You're simply saying, I'm going to wait for now, and I'll get the information from the insurance company as to what steps I need to take I should say, not if, but when I'm ready to take that annuity benefit and make those elections at a later date.
Yep, correct. You actually can't make any kind of selection or start the process until 180 days before the date that you would like to begin. So if you're interested in starting at 65, then as you near your 65th birthday, you would then give the insurance company a call. You would let them know that you're ready to start the process, and then they will send you election materials to help you get started.
Okay. And if you are rolling over the lump sum to an IRA, can you just confirm, again, this is a standard IRA, are there federal or state taxes taken out of that?
Okay, no. So if you're rolling to the 401k or you're rolling to an IRA, there are no federal or state taxes that are due. That's sort of the advantage of the rollover, is that it doesn't trigger any federal or state taxes, and it avoids any sort of penalties.
If you are considering rolling over to an IRA, does Dassault Systems choose that IRA holder, or do you have to specify, in essence, do you have to already have your IRA set up for those funds to roll over, or again, do that certainly within that 60-day window? Yeah,
so Dassault has no input over what IRA custodian you want to use. So if you want to set up an IRA at Fidelity, at Schwab, at E-Trade, at Bank of America, at wherever, that's up to you. So you decide where you want to set up the IRA. I think in reality, you'd probably want to have that IRA. You don't need the IRA established to make the election, but when you get the check, you probably are going to want to have the IRA ready to go so you have some place to put the money. Mm-hmm. So if you're thinking about the IRA route and you don't have an IRA set up, I would start looking into where you want to set up the IRA and fill out the paperwork to establish the account.
And if you are choosing the cash option, so rolling it over to cash to yourself, or the lump sum option is taking it as cash, are the taxes and penalty calculated against the gross amount in both cases, or do they do the penalty after based on the net that you're receiving?
Right.
No, unfortunately, all the percentages that you're going to pay will be based on the gross amount. So the 10% is on the full, in my example before, $50,000 lump sum gross amount. You'll pay $5,000 in penalty, and then separate from that, whatever tax bracket you end up being a part of, you'll pay on the full $50,000.
Right. So I mean, just another little side point around that is recognize if you are taking a relatively large lump sum in cash, just be aware that if it's big enough, it could push you into a higher tax bracket.
True.
So that would be another thing to contemplate is if you're taking significant amount, you may end up paying more in taxes across the board because of that lump sum payment if it pushes you again into a higher bracket.
Mm-hmm.
With the paperwork that was provided to employees, the lump sum value varied for individuals, but it could be 100%, could be much higher than that. Can you just describe what that valuation means?
So the relative value notice? Mm-hmm. Yeah, so in the informational packet, there's a page that has a relative value notice. So basically the government requires that pension plans compare all of the options to one another so that you can understand if one or another option is more valuable than the others. Now there's a lot of things that we have to assume when we're doing that calculation. So one of them is that we have to assume an average health. Obviously, someone who's in very poor health, the value of the lump sum would be much greater than the annuity payments. But all other things being equal, average mortality and the interest rates that are on there, if all the values are 100%, that means that there is no financial incentive one way or the other between the annuities or the lump sums right now. There's a lot of participants in the plan that are in that situation. There's also a group of participants that the annuities are all 100% equal to each other, but the lump sum is of significantly greater value. And that has to do with the annuity reduction rates that are in the plan for certain participants. For certain participants, the annuity reductions are at about 8%, somewhere between 8 and 10% reduction, and the lump sum early reductions are at 4 or 5%. So pay attention to that. That can help give you some ideas about what would be the best option for you right now.
And we've somewhat addressed this already, but in essence, if an employee is contributing to the Roth option within their 401k today, and in essence, they want this money as Roth dollars or after-tax dollars, is there a way to do this, or is there an easy way to do this in terms of rolling it over to the DS 401k plan, but having it be a Roth contribution?
Yeah. So we don't have a Roth conversion feature in the plan as it stands right now. So if you roll the money into the 401k, it will stay as pre-tax. If you roll the money to an IRA account, you could convert that IRA to a Roth IRA. And again, for conversion, there are no income limits on that. People sometimes get caught up with, well, I heard that I can't make a Roth IRA contribution if I make too much money. So that's going to prevent me from having a Roth IRA. It might prevent you from being able to make Roth deposits, sort of the traditional, $6,000 annual deposit, but this is a rollover, which is different. So for a rollover, there is no income threshold. So you could roll the money to the IRA and then call Fidelity or wherever and say, hey, Fidelity, this rollover IRA, I want to convert it to Roth. And boom, it gets converted. The thing to keep in mind, though, is remember, if you convert this, you are triggering the tax. So if I get a $100,000 payout from the pension plan lump sum, I put it into a traditional IRA and then I convert it to Roth, that conversion creates $100,000 of income for me this year. So now I owe, $22,000, $28,000, $32,000 of income taxes because I converted to Roth. You don't pay a penalty, so the penalty is waived for the conversion, but you do need to think about, all right, where am I going to get the money to pay the taxes on this if I convert it? Now, mind you, you don't have to convert it all at once. You could parse it out into different amounts. So you could convert a piece this year, convert a piece next year, et cetera. But, if you are thinking about trying to convert all of it at once, just recognize you be prepared to pay the tax on all of it.
And you're doing that paying of the taxes with your annual tax return.
Correct. So that would all be on your 1040 is when you'd settle up.
Okay. And again, we touched on this earlier, but I suppose just for a reminder, you do have the ability to roll your funds, roll over these pension assets into your 401k. Because it's rollover money, you do have the option at any point in the future of rolling it over to an IRA. So it is giving you, if you chose that option, it's giving you some flexibility of, yes, you've parked that money in your 401k today, but at any point in the future, just like if you rolled over funds from another employer, you can roll those funds out of the DS 401k plan at any point. So if you're not sure if you don't have an IRA set up today, or you just don't want to deal with that time pressure of 60 days, that is an option, is roll the funds into the DS 401k plan, and then whenever you're ready, going back and rolling those funds out to an IRA. I think Kendall had mentioned before, though, again, the funds are going to roll into whatever you're invested in today, or whatever you have set up at the time that these funds from the pension rollover take place. Whatever you're investing in, that's where that money is going to go. So just keep that in mind. Do traditional IRAs allow for loan withdrawals like the DS 401k plan does?
No. So you can only take a loan from a 401k plan. You can't take a loan from an IRA.
And this is a very good practical question. How do I know that my election has been received?
So after that's a good question. After we receive elections, we'll send you a confirmation letter. The confirmation letter will do a few things. One, it'll just give you reassurance that we've received it. I encourage you to make a copy of the election form before you mail the original to us. That way, if something got lost in the mail, you'd have something that had, a date on it that was before the election due date and that kind of stuff. The letter will also give you some good information, some reminders of what's going to happen depending on which election you chose, like when to expect a check, if a check is coming, what's going to happen if you roll to the 401k, the DSO 401k, and that kind of thing.
Okay. One of our participants is considering, in essence, rolling the lump sum into an annuity product of their own selection. What option do they choose in order to go that method, or might that be more technical than we can probably answer on this call?
Yeah, I mean, I guess first I would caution against. I mean, unless you really like, there's something about that product that you really like, that annuity product, but I would caution against it. So if you wanted annuity, typically the best option for you would be to take an annuity from this plan. If you would rather, have the money in an account that looks more like a 401k, and then you want to, see it grow, get some cost of living protection, that kind of thing, then go that route. If you take the money and then try to buy an annuity through an insurance company, like an individual annuity product, you will have to pay all the administrative fees for that product. If instead you take the annuity through the DSO plan, DSO is paying for all of those administrative costs for the remainder of your life. So it's financially more advantageous for you to take an annuity directly from the pension plan. But there could be, some other reason that I just don't know about with this particular case, that there's something very attractive about that product, or other consideration.
Call the pension service center and eventually get rerouted to you or someone else that can help them with that type of question.
Yeah, or it might be a good Kendall question. We could always set up some email time or some conversation time with Kendall, because it could be a very specific reason.
Yeah, I mean, a lot of the annuities that are kind of on the open market, so if you went to an insurance company and just said, okay, what kind of annuity products do you have? Many of them will have, a whole list of these kind of add-on features or riders that go with the annuity that might guarantee, might have, so maybe that annuity has kind of mutual funds inside of it, in which case it will grow over time, or it may have different sort of death benefits, but all these other riders you pay for. There's a cost associated with them, because the insurance company that's issuing the annuity, they got to pay for it. They got to cover the risk somehow. So unless there's a feature within the annuity that's particularly attractive, again, sometimes some annuities will say, okay, if you're not taking the annuity payments right now, if the annuity is still accumulating, there might be kind of mutual funds inside of it. So you could invest the money in the mutual funds. And then if you died, there might be a variety of different ways that the beneficiary might receive the money. They might get whatever the annuity is worth. They might get what the annuity was worth over the last 5 years, maybe the best, highest market value over the previous 5 years. That's what gets paid out to the beneficiary. So it's not necessarily the current market value. So these little twists, I guess you could say, are, other kind of components that can be added to new annuity products. But again, you pay for them. So the annuity that you get from the pension plan is a very kind of stripped down basic annuity. We're going to pay you X amount for a certain period of time. It's either going to be over your life, it's going to be between your life and your spouse's life, it's going to be for at least 10 years with no other sort of extra special stuff put on top of it. So if you're thinking about buying an annuity on the open market with some of the dollars, you could certainly do that, but it's going to cost more than what you would what you would get from the pension plan. I'll leave it at that.
Okay. I think we've mentioned several times during the presentation about the need for a notary for if you're taking a lump sum benefit. Can you just clarify that the notary is only needed if you're married?
Correct.
Okay. And I think there may have been some confusion about that IRA, like if a person is choosing an IRA, they're taking the lump sum, it's going to an IRA, they're going to receive a check, correct? But again, at this point, no taxes are withheld.
Right.
The issue is really you need to put that money you're going to take that check and put it into your IRA. You are actually receiving a check though. There's no taxes withheld at that time. The taxes would apply if you're cashing it and not putting it into your IRA.
Yeah. So if you pick an IRA, let's say you've identified Schwab, you like some product that they have or something like that, and so you would check the box that you want to roll over to an IRA. You would write Schwab on the line, and then a check will be issued and mailed to your house that says payable to Schwab. And then it'll say FBO, and then it'll say your name. So it's payable to Schwab for the benefit of, John Doe. And then you will take that check to Schwab or mail it into Schwab, either way, along with a form that they will need to accept both the money, and then they'll set up the account for you.
Okay, and I just want to point out, she's using Schwab as an example.
Yes.
Right.
Again, we said this before, but it came up in a question. If you are choosing an IRA, this is an IRA that you have
pick
set up.
any one you want.
And it's Charles Schwab or any number of financial institutions. There is no option for you to choose IRA, and Dassault Systems has already chosen an IRA company for you. That's the legwork that you would have to do if you wanted to put it into an IRA. Dassault Systems does not have a program set up with Charles Schwab, the example used. That was purely just an example. You actually have to select and create your IRA account, and it can be with whoever.
Just to add to kind of what Nicole was saying about the mechanics of this. So I think the key here is when that check shows up, it's not made payable to you directly. It's not made payable to John Doe. It's made payable to, in our example, Charles Schwab for the benefit of John Doe. So because it's not made payable to you directly, that's what causes it not to be taxable. You're not getting it made out directly to you. It's being made out to the custodian of your IRA account.
Again, if you are deferring, you don't need to complete anything at this point. Again, we are asking that you would call the Pension Service Center to just validate and confirm that that is the option you're choosing, but there isn't any forms that you have to fill out or have your spouse notarize at this point if you are choosing to defer. There's no action for you to take at this time. What is the last date to roll this over to an IRA? Again, I think this.
Yeah. So in this example, you'll get mailed that check, and then you have 60 days from the check issue date to get that deposited into your IRA account.
I don't know if you're going to be able to answer this one in the short amount of time, but what's the advantage of rolling it over to a Roth IRA versus a normal IRA?
So recognize you can't roll it directly to a Roth IRA because this is not Roth money. This is effectively pre-tax dollars. So it would kind of be a two-step process. You'd need to roll the money to a traditional IRA and then convert to Roth. So the advantage of rolling to the traditional IRA is you don't trigger any taxes. If you decided to convert that traditional IRA to a Roth IRA, you would end up paying the income taxes. It will trigger the taxes, but then any of the growth on the money is income tax free. So you kind of have to decide, are you prepared to pay the income taxes now? Do you have the money to actually pay the income taxes? And is that, something that you ultimately want to do?
Yes, I think I think when Roth first came out, a bunch of my colleagues and I got together in a room and did a bunch of modeling, and it boils down to whatever tax you think you're going to owe for 2019 on this money. If you do Roth, you pay tax now. So let's say that it's 30% is the tax that you would pay today if you took that money in Roth after you lumped it on top of all your other income that you're receiving. Versus, let's say you were going to take all that money 20 years from now. The question is, what tax rate do you think you are going to pay 20 years from now? Are you going to be in a lower tax bracket or a higher tax bracket? And do you think that taxes in general are going up or going down in the future? So if you believe that there's too much government spending and that taxes are going to have to go up because of whatever's happening in society, then you might want to do that now, pay that tax now versus later. If you think that taxes are going to stay the same, but because your income, W-2, income is going to go down in the future, then you might want to pay the tax later.
Right.
So it's very speculative.
Yeah. I mean, one other thing that would be a good homework assignment for people if they haven't actually done this is to look at the tax bracket. You can Google it. Just if you're single, if you're married, filing jointly, look at the brackets themselves. Because I think a lot of times people presume when I get to retirement age, I'm going to be in a lower income tax bracket because I'm not working and I'm going to have less income coming in. But the income needs for people may not change quite as much. If I make $100,000 this year, right now, and I'm retiring next week, is my lifestyle going to change so dramatically in the next 7 days that I'm going to be able to live on less? All right. That might be the case. Who knows? I'm speculating. But my point on this is when you look at the brackets, especially if you're married filing jointly, what you're going to find is the brackets are wide. So there can be a big disparity in income in terms of what it takes to actually get to a lower income tax bracket. So off the top of my head, don't quote me on this, but everybody can Google it while we're on the phone. If I was in the 22% income tax bracket and I'm married filing jointly, that range is people making anywhere from, I think, $77,000 to $165,000. All right. So if I make $150,000 a year, I've got to get my income all the way down to $77,000 a year to get to a lower tax bracket. So I would pose the question to people, if you're used to living off of $150,000, can you cut it in half in this example? Would you be able to survive on 50% of the income that you had before just to be able to get to a lower tax bracket? So look at the brackets first. See where you are. If you're right on the line, if you make 80 grand, all right, it's not going to take much to get to a lower bracket. But if you're way up at the top end of the bracket, you got a long ways to go to get to a place where you're paying less in income taxes. So that's something else just to contemplate. Okay.
We are at 3 o'clock now, so we're going to just do a few more questions, but then we will have to end the call. A few of these ones, I know we covered it during the meeting, but I just want to reiterate. So one is, if you are choosing to take the lump sum and have it go into the DS401k plan, you will not receive a check mailed to you. The funds will automatically get sent from the pension plan to your DS401k account. All you're doing is completing that election form that has already been mailed to you. You don't have any other action to take after that. The second thing is if you that you can take the lump sum and you can divide it out, meaning if you wanted to take some as cash and roll over some to the DS401k plan or to an IRA, you can absolutely do that. On the form, there's an opportunity for you to split that lump sum payment. Again, if you're taking part of it as cash, you're going to be paying taxes and the penalty on that if you're under age 59 and a half. One last question is regarding an IRA contribution. So typically an IRA contribution is tax deductible. Does the rollover option qualify for this type of deduction towards the contribution limit for the year? Or since it's a rollover, does it not really apply?
Yeah, you don't get a tax deduction for the rollover.
Okay. Well, thank you all for your time today. I certainly want to thank Kendall, Felicia, and Nicole for their time today. Undoubtedly, we didn't get to every question that was asked in the question box in the GoToWebinar. That said, you do have the phone number for the Pension Service Center. Please reach out to them with any questions that you have. Similarly, if you have an investment question or are looking for some type of financial advice, you can reach out to Kendall, who's been our 401k advisor for, I guess, 9 or 10 years at this point. So hopefully all of you know him, but those would be 2 avenues for any questions that we didn't get to. But again, thank you for your time today. We will send out the recording and the presentation to all of you. Again, if you are a vested term participant and want a copy of the recording or the slide deck, please email me. It's Colin Murphy, colin.murphy@3ds.com, and I can send that to you as well. But thank you all for your time today, and we will talk to you all soon. Thank you.